Welcome, Simon, and welcome to everybody. Thank you for joining us. And we are today a bit late, but not as late as last month, but still a bit late, and we apologize for that.
My fault both times.
But also, life happens in between all of these recordings. However, we're celebrating one of the best starts, first quarter starts the JSE has had in over a decade, and we're going to talk about that. We're going to talk about the biggest winners and losers in March, and once again, resources dominating in that space, and we're just going to dig into those and just look at who did badly. Tailing biggest losers, or right at the end, was Aspen. We've spoken about them, but maybe we can get a bit of an update to see how we think that's going to go. Also, less than a month to go to elections, so lots happening. Moody's gave us nothing.
that is the new winning. Don't knock it.
Yes. Which it was nothing, but we're grateful. Nothing's good. We can live with that. So perhaps, Simon, let's talk about the JSE and the performance first quarter. We did really well. Resources pushing us to the top. Pushing us to that new best in over a decade. What gives?
So, thanks, Dino. It is, as you said, and I think we've probably said this every month this year so far, and many months last year, resources has been the absolute, the out-and-out performer, driven by a couple of things. I mean, so not really currency. Yeah, currency moves, but it's broadly where it was at the beginning. 14-ish is where
there hasn't been much movement there.
It's almost getting boring in a sense. No real corporate actions or anything. There has been some boost in prices. We just last week saw platinum spike on the back of palladium collapsing, kind of offset. But we're a bigger producer of platinum than palladium. Gold's been edging higher. Iron ore's been in a tear. Now, iron ore, initially that goes back to the Vale disaster in South America, back in Brazil, back in January. But it's now north of 90, and I didn't expect that to happen. That really, really did surprise me in terms of the continuation of the run in the iron ore price. And that tells us a couple of things. So obviously Vale's pulled a whole lot of supply out of the market. The other miners are, because we've had the glut and then which was sort of 08, 09, 2010, that's been pulled out. A lot of Chinese production and stuff has been pulled out. A lot of demand as well at the same time. But what we're in a situation where the mines are not able to turn on increased production perhaps as quickly as they have at times in the past. And that's because miners these days are much more sort of lean operating machines. And I think so iron ore certainly helped. In the local space, that's Assal, that's Kumba, and that obviously feeds into Anglo-American. BHP Billiton has a lot of exposure in Western Australia as well in the iron ore space. And they produce at sort of $25 a ton, selling at 90. Kumba produces at about 40, selling at 90. The margins are back. Iron ore was $40 3 years ago. But there's a bigger picture with it, which we've spoken about, which is that probably the balance sheets of the big mining companies are healthier than they have been in the history of big mining companies. They are generating huge amounts of cash flow. They have little to no debt. The debt that they've got is cheap debt because of low interest rates. They've been paying that debt off aggressively. And what we haven't yet seen, and maybe it's still to come, is the mega sort of deals that happen at the top of the market. And truthfully, that's what scares me. But maybe it's different this time. I hate that phrase, but maybe we have a different breed of miners, the Mark Cutofanis and the like, who've come through and who've almost gone back to the classic sense of mining. If we go back to the 70s and 80s in South Africa, there were dozens, hundreds of gold mines listed on the JSE. And the reason is twofold. Firstly, lots of gold, which is now gone. Yeah. But also, every mine shaft was an individual company. So you had Beatrix, one shaft. You had Kloof, a shaft. And they were all individual shafts. And they would mine that shaft out, and then it was over. And
that was it.
If there was 15 years of gold in the ground, and your dividend yield was 7% a year, boom, you made money. Gold
and you left,
and you were happy. So it maybe it's the reign of responsible miners again. And certainly when I look at the mining stocks and their current commodity prices, current currency prices, they're not crazily expensive. They're still off their all-time highs. So certainly miners don't look undercooked at all. The other one then has been banks. Now banks they've had a mixed
March was
first quarter.
Not great.
No, it absolutely wasn't.
And I suppose we can get into it now, because it was one of the things I wanted to say. Financials down in March, so not great.
But they're looking like they're picking up, and a lot of our banks are cheap. They're making very modest profits in an economy that is not growing.
Yeah.
Imagine an economy that does grow a bit. They don't have bad debts. The impairment levels are, outside of ABSA, sub 0.5%, which is incredibly low.
So well managed.
And that's in part bankers being like miners, responsible, who knew, but also National Credit Regulator, which in the last 12 years has frankly made it harder to lend money to individuals, and we're seeing the flow through of this. So the banks are the resources are running. The banks are well positioned. And interestingly, I've got a lazy trading system that trades ETFs. We went long the Resi, I think the 4th of Jan. And if this week plays well, we go along the Finny on Monday. Now, trend systems, you go long, you get out, but at some point that trend goes. Our banks look cheap at the current levels. Just last point on the best quarter start to a year in some markets since 1987, to which everyone says, oh, 87, remember the crash? Yes. Yeah. October 87, JSE lost 22% in one single day. It remains the single worst day in the history of the JSE. Here's an interesting factoid. For the calendar year of 87, the JSE was green, because it had such a crazy run up to October. It then falls 22% in a day.
But it's still up.
And in total it falls 35% in the week, and rallies again, and actually closed the year green. So 87 is not your horror story. 2008 is your
horror story.
87 was a horror minute or two, and then we all moved on.
Okay, so I did say we were going to, chat a bit about the biggest performers, biggest gainers and losers. So in terms of our top performing companies, we've got Kumba at the top, and Rand return 19.5%, US 17%, and then following that, BATS 18.7%, Rand return 16.2%, US return, and then Northam third at 14.8% Rand and 12.3% US. So and then there's financials and AB InBev and MTN somewhere in there. So there's quite an interesting mix, but in the top 10 easily very much dominated by resources.
Yeah, and the Kumba share price is almost back to those sort of pre-collapse levels, which we saw 10 years ago. But the iron ore prices in the 90s instead of 170s. But what happened was that Kumba became lazy. It was just too easy to make outsized profits. And there's an interesting point. In the olden days, in the very olden days, in the 90s, iron ore was done on annual contract price. So you would sit down with your suppliers and do an annual contract price. Then it moved to quarterly contract pricing. And then around about 2007-8, it just moved to on the market spot. Pay what it is, and that's where the price go crazy. That was the whole the whole boom in China, etc., etc. But interestingly, Kumba at a commodity price that is maybe 60% of where it was before. Sure, a weaker rand, but it's the efficiencies. They've closed down all of the bad shafts. They were having issues with head grades and stuff like that, and they've resolved all of those issues. They've got their line to Saldanha operating like absolute clockwork. Useless factoid, the line, a truck went under the railway line to Sodana and smashed it. And the Germans said it's going to take 2 weeks to fix it. The railways people, who are they? Not Prasa, but Transnet.
Yeah.
Transnet engineers said, no, we can do it in 10 days. And the Germans were so aghast, they walked away and said, this is ridiculous. And they fixed it in 8.
Oh.
So they made a temporary bridge, and then you make another temporary bridge, and then but the point is that things are just, everything's operating at peak efficiency. Your BTIs and your InBevs are two of those sort of large defensives with a lot of debt in their balance sheet. One bought Reynolds, one bought SAB Miller, probably both overpaid. The only debate is by how much. But what's important there is that the prices had been slaughtered. Both, AB InBev not quite 50% off the highs, BTI is certainly 50% off the highs. And even if you put in some less enthusiastic forecasts of the next decade for them at those prices, at sub 500 for BTI and sub 1,000 for InBev, the valuations were massively attractive. Truthfully, you could have said the same thing at sub 650 and sub 1,200. It's easy in hindsight to spot the turn on the way down, less so. They both have challenges aside from the debt. Challenges in the beer market is moves away from beer, moves to craft, which they can kind of do but not really, but moves to sort of alcohol pops and gins and there was a rum festival this weekend and all of those crafty type things.
It's all going to go there.
Yeah. BTI's problem, and I think this is a bigger problem for them, is that they were moving eastwards as legislation in the West became more and more staunch. America, Europe, South Africa. We've got pretty staunch tobacco laws, and there's a new tobacco act coming which is going to make smoking indoors illegal. No smoking areas.
No smoking, ever.
Yeah. Which interestingly hurts casinos very much so. Go Google Australian casino smoking laws to the listeners. Typically it hits them about 30%. It takes them about 3 to 4 years to recover that loss of income. The problem with BTI is with the vaping. My sense is they've raised their heads above the parapets again, and the authorities, the regulators in America are now coming for them again. And the big stat I saw is that of teenagers smoking in America, the number has gone from like 7% to like 18%. And the argument that, oh no, but they're vaping, not smoking, you can argue that all you want. Regulators across the world are saying they now don't refer to cigarettes, they refer to nicotine delivery devices.
Yeah.
Whether it be a vaping thing, whether
or
it be a
cigarette.
And I think, and so there was talk around America clamping down on all flavor, which is menthol, which is a huge part of BT's life. And I think that they might have, where everything had quietened down, they might have brought the ire of regulators in the US again. But even if we take that into account, at sort of 600-700, BT's offering value for a defensive, decent dividend-paying earning in sterling.
Okay, and then I just wanted to focus a bit on our bottom performing companies, because that list looks really, the top 10 looks really, really interesting. And at the top, we've got Aspen down 33.3% in Rand value and 35.8% in US value. However, and then followed by Fortress. But the very interesting thing is then straight after that you've got Absa, the JSE, Mr. Price, Pepkor, Nedbank, Brait, Discovery, CAP, which is and PSG Consult, and then Investec. So you've got just quite, like we said, quite a few financials. But perhaps let's just focus more on the Aspen story. Is this it? Is this as low? I mean, yes, I know. How low can it go? 0. However,
I must preface this, and I don't know if I did, but I would wager that a month ago, when we did this podcast, pre the results, at about 100 or 130, 140 on Aspen, I said this offers value, but let's see those results. So I was I was both right and wrong, which means I was like, no. Either head on the block or
not.
I kind of put a half an year on the block. So Aspen hit 70 and is now trading around 100. Aspen's, there are a couple of issues. The biggest issue is that their sale of their milk formula business hasn't gone through yet. It's still waiting for regulatory approval in New Zealand. I have dug around that left, right and centre, and I can see no reason why not. except for fears around foreigners controlling parts of the economy in New Zealand, which is not a unique situation to New Zealand.
Yeah.
From the White House to Nkandla, we have those issues.
Yeah.
No longer Nkandla. But it should go through. But in the meantime, they're in breach of their debt covenants. They need to get rid of their business. They still, even after paying that off, they've got debt of around 45 billion, in excess of their market cap. Then the question is, what else might they need to have to sell? And what Aspen always did was bought assets, paid cash for the assets rather than script, which I like. But the problem then is that you've got to keep that cash flow generating,
Right.
and you've got to keep that dance moving forward. And when it stumbles, EOH, different model, but same sort of stumble. Aspen, same sort of stumble. Is Aspen a global provider of important generic medication around the world? For sure. Does it continue to be so? Yes. But there's a difference between the business and the sort of fundamentals of the business.
Yeah.
And in this case, their debt burden is simply too big.
Too high.
And the question is, let's assume the milk formula deal goes through. They still got a lot of debt. What's the plan for it? They're back within their covenants at that point. They've got to aggressively pay off the debt. They were never very good dividend payers, so dividend's not
That's
an
not
issue. But certainly no new deals, which means we've gone from a high flyer company growing at 40% a year at its peak to a company that's going to frankly do single digit growth. At a single digit
And for
growth.
a while.
Yeah. And at a single digit growth, even post those results, $100 is cheap. I mean, the results weren't as great as I hoped, but at $100 it's cheap. But what's going to be the catalyst to get it moving? Now, Aspen has a potential catalyst, that milk formula deal going through.
Yes.
If that goes, that could be your catalyst. My view is let's wait and see. There's no mad rush, but I mean, I remember writing in FinWeek when it fell from 440 when GSK did one of the sales because they owned 18%.
Yes.
They were selling the second tranche, and it fell to 360. And I said every time in the history of this share that it's fallen more than 10%, it's been a buying opportunity.
Yeah.
Yeah.
But and now we're at.
But what I missed with the scenario, my stat was right, but what I missed with the scenario was the fundamental change. Every growth business ultimately becomes a mature business. Some of them handle that transition better than others. Some of them don't. Some of them handle it poorly in tough times.
Yeah.
We go back to January of last year when we heard Viceroy was coming. One of the stocks that people were looking at was Discovery, and the other one was Aspen.
Yeah.
And the Aspen story was around their debt. They went for Capitec in the end.
Yeah, which was
and that really didn't work. Capitec back at all-time highs, but we're in a market that is scared. You know, those Aspen results 3 years ago might have seen the stock down 10%.
Now it's just
on the day it was off almost 50 and recovered to close only 30. We're in a new world, and it's a fearful one for investors, and that knife cuts both ways. If you're on the wrong side, it's scary.
It's scary.
If you're looking to buy Aspen at under $100, well, apparently that boat hasn't sailed. I want to also quickly pick up on Investec because they're doing their split, right? Banking and asset managing. In my sense, my running the numbers and my trying to figure it out, and their asset management has been a very rocky process, starting with the purchase of Kensington in the UK about a month before subprime exploded, and Kensington had tons of it. I think there's value in Investec. I think the banks generally, Capitec's a beautiful bank but expensive. I think there's value generally in the banks, but Investec is on just that breakup, on that split. I think much like we saw with Old Mutual and its breakup and the ultimate value, and Naspers and MultiChoice value, I think there's value in that break split with Investec.
And perhaps let's just look at quickly ABSA and Nedbank, and then because those are the two out of the big four, those are the two worst performers. ABSA down 15.8% in rand value, 18.3% in dollar value, US dollar value, and Nedbank slightly better but still quite down, 11.7% down in rand value, 14.2% in US value. And once we've done that, I think we can then touch on Mr. Price because there's an interesting thing there.
The Nedbank one, is I see no good reason for it. So Nedbank's in a weird position. You can see very clearly with FNB, First Rand, and with Standard Bank, you can see their strategies, you can see their plans, you can see it coming through in terms of appointments they're making in the C-suite. You can see it coming through in their numbers, and all you need is the economy to come together, and it works.
And it works, yeah.
Nedbank, I mean, they got the ETI, a minority stake. It was a disaster. It's coming back. But, I mean, you don't think of Nedbank, and the Nedbankers listening are going to hate me for saying this, but you don't think of them as big corporate wheelers and dealers, whereas you do with the sort of RMB, FNB stable, with the Standard Bank, CIB stable and the like. And there's a bit of a sense out there, what is Nedbank? They're kind of betwixt and between. Yeah, retail banking, unless you're Capitec and at that end of the cost curve, retail banking is not
Isn't
your future.
Their strong point, yeah.
Your trading arms, your investment banking, Nedbank seems to be a little bit behind. Maybe not within South Africa, but certainly within the broader continent, and that's hugely important. ABSA's huge challenges, losing Maria Ramos, who I have huge regard for. I thought she was great at Treasury. I wasn't so. Transnet will park that.
Let's not go there.
But her leaving and no replacement is shoddy on behalf of the board. The bigger thing is that the breakup from Barclays is doing a couple of things. It's creating a lot of restructures, so people leaving, which means new people coming in, and that's not the problem. The problem is, when you've got a whole bunch of new people, it's integrating them into the process, getting them into for want of a cliche, the culture and all of that.
And slotting them into the strategy, really.
And the strategy right now is not full steam ahead because you've got this breakup that you're going through. That is, that yes, is mostly whatever funded by Barclays, but it takes time. Yeah. It's taking resources. Maria Ramos was spending X hours a week on that, where she couldn't be on their Africa deal, because they've got a great Africa presence, because they've got the Barclays business. They've got to rebrand it, and that's going to be a bit messy, but in 5 years that'll all be fine. So that's ABSA's current challenge there. My sense was also that Barclays was squeezing them for dividends and was being extra cautious on loans, etc., perhaps more than they needed to, although they do, oddly enough, have a fairly high impairment compared to the other banks. But my pick in the space is usually going to be the FNBs or the Standard Banks. But ABSA, there's a lot they need to get right, but let's give the team the benefit of the doubt. The bank is cheap. Very, very cheap. And the economy, I mean, it can get worse, but the economy is we see some glimmers, and then Eskom turns the light off and the glimmers disappear.
Yes.
I do want to say quickly in the elections, we're less than a month to go. I've been dreading this election run-up. I thought it was going to be so evil and so toxic. Maybe I've just been spending my time on the beach in Durban, but so far it has been, to my sense, not as ugly and as horrible as I thought. And it gives me hope, not for anything else, that maybe we can have an election without killing each other, which is...
I don't know, in KZN might have...
Well, I mean, no, and as I say that, I suddenly think of Alex. I mean, yes, I mean, but it hasn't been as toxic as
previous.
And I'm looking at the Twitters and the Sunday medias and that sort of thing. It hasn't been as toxic as I thought. But maybe also my fear that it would be means I've extracted myself, and now frankly it's happening, and I'm just ignorant and missing it. Not impossible.
So I wanted to touch on Mr. Price, because a very interesting thing is, Woolworths is on the other side, while, as part of in the best performers list, not high. But here's Mr. Price, and down 12.2% in Rand value, 14.7% in US dollar value. What's going on?
So Mr. Price is perfectly positioned, right? They sell cheap clothing, and my view is cheap quality, but that's fine.
It's debatable.
You buy it for the season, and all's good. But I just took a spin through Woolies, and man, I love those Agora lamb virgin wool jerseys, but 1,000 Rand for a jersey? Like, you are kidding me. I expect to get an entire lamb on the side for 1,000 Rand. So Mr. Price really have their niche. We mentioned a moment ago, National Credit Regulator clamping down on debt, which plays into Mr. Price because they're a cash business. They've got Mr. Price Sport, they've got Mr. Price Home, etc., etc. What they did, though, was they stumbled. And they've done it now twice in the last 5 years, which, frankly, they've done it twice in the last 25 years, both of them more recent. And suddenly, so let's quickly take a sidetrack to Woolies. Woolies occasionally gets clothing right. Usually they get it wrong. Clothing is immensely hard for a bunch of reasons. Part of it is your lead times. I mean, you're currently in April ordering your January clothes. And yeah, I don't know what I'm going to be wearing in January, for goodness. It'll be summer, but, so there's challenges. And one of the things Woolies has tried to do is shorten that. But whereas Woolies struggled to get it right, and I think the fear is maybe with Mr. Price is a sense of, well, hang on a second. How possible is it to perfectly knock it out the park every time as a clothing retailer? Is it perhaps more likely that a really good clothing retailer will get it right most often, but not always?
Not all the time.
And Mr. Price, my sense is, has been priced for getting it right always. And maybe there's a new sense out there, and I'm not saying they're going to become Woolies, and if they do, that share price has got a heap of pain. I'm not suggesting that, but I am suggesting that the new reality might be that, you know what, this is there are going to be some misses. And that then brings Foschini Group into the picture, because the Foschini Group are the one guys who, you got to say, haven't yet stumbled.
Yes.
And if we take the theory that maybe the new reality is that you don't always get it right, well, then when does Foschini get it wrong?
Wrong.
And that's going to be a bloodbath when and if it happens. And maybe I'm wrong, but that is my sense of what the market is digesting at this moment. And again, to what I said a moment ago, a market that is deeply unforgiving. You stumble on something, the market remembers. 5 years ago you stumbled, and within months, weeks, we'd forgotten, we'd moved on.
But now
this is a different type of market. And I think they're saying, is it possible to hit that 6 every single time? They have, and it's tougher out there. H&M, Zara, all those other peeps suddenly mean that your margin of error is so much smaller. When you erred before, your consumer choices were limited. Now you err.
That's it.
I just went through Rosebank, man, and it's just clothing operator after clothing operator. I mean, pick your price point, and you've got a choice, a real choice.
So it's actually quite interesting that, and I'm going to stick to the retail thing, because, Edcon has obviously been the big elephant in the room that fortunately we're all starting to recognize and we're all talking about, but it's still, no one actually knows what's going to work, what's not going to work. However, I was in Edgar's in Sandton a while back, and I don't go to Sandton City very often, but I was shocked to see that they have 3 floors. And it was very, very busy. And funny enough, I was also with a colleague, and we're like, I thought they said they were scaling down, So, and just seeing the busyness, I suppose, of Sandton City and seeing people go in and out, it's almost, you sort of wonder. I mean, yes, richest square mile in Africa, so obviously those are the last people going to be affected. But we've got so many malls popping up. We've got just so much. I mean, Mall of Africa, and I say this because I've been sort of mall hopping, so I've been to the Mall of Africa just to look. And the Mall of Africa also has huge Woolworths, and but now you've got all these. There's a shopping center coming up in Tembisa. There's just shopping centers everywhere. Within the retail sector, knowing that you still have to cater for all these shopping centers that are essentially, I think, cannibalizing each other. Like, what's the end game? What's the end play here? And then you've got the demand for online. You've got your Superbalist, your Take-A-Lot. Every single pair of sneakers I have bought, except for one, I have bought online.
And our online, comparatively compared to like the US, we're nowhere. I mean, our online is not even starting. I dipped my toe in and bought a shirt online, and it fitted because I wanted to try the return policy. But their return policy was like no problem.
Yeah. And I say this because I remember I bought sneakers. They were too big. I sent them back, and then they were too small, so I sent them back, and then I finally got the right size, all free. All 3 times.
I'm surprised they haven't just blocked you. Like when they see Neo, they're like, no, we're closed. Sorry, we don't work anymore.
Yeah, but
But you know why they can do it? Because that triple level building in Sandton costs a badonna fortune. It is frankly cheaper to send you 3 pairs of sneakers and return 2 of them than to rent 3 levels.
And so, and I suppose it makes sense. I work for Standard Bank, a very big building. So when somebody's delivering shoes, which they always do, they're picking up shoes.
Sure. No, fair point. Absolutely. And so the future for retail, I think, is, and it's moving more and more online. I got friends in the US with Amazon Prime. I mean, they don't go to the store anymore, like for anything, unless you need it like in a hurry. Amazon Prime, 2-day delivery, zero cost. They buy everything, and they happen to live in San Francisco, so they can get Amazon Fresh as well. So they in the morning will have a look-see and plan their dinner and say this and that, and Amazon delivers it between 3 and 4 to their place of work, or if they want, between 6 and 8 to their place of home. So that is certainly a big part of it. What I also think, so what that leads into, and then we talk about the death of department stores and malls. I don't think so. But what I do think is, does Edgar's need 3 levels? And Grant Patterson will tell you no. And in many cases, they're shutting down, reducing size. In some cases, and I don't know if this is an example of Sandton, they've said to the landlords, look, we've got too much space. When you find someone to take over some of our excess space, we'll downscale then. In other words, they won't leave big gaping holes. They will do it in a coordinated process. But I think it is to smaller stores. Perhaps I go into Woolies and I see their jerseys without the lamb on the side. But I really wanted the blue one. And the lady's like, well, we got it online. And I've got my phone, or maybe there's frankly a computer just there and I use theirs or something like that. So your stores then almost become showrooms, more than anything else. And some retail less so, certainly in the cash retail space, because online doesn't work in a cash environment. You've got to have credit cards and the like. And
although nowadays debit cards.
I mean, certainly our unbanked situation in South Africa is nothing to what it was 15 or 20 years ago. Then the question flows to, okay, so retail, it survives, it morphs, more showroomy stores, more online, more combating, whereby if you see the price cheaper at Amazon, I'll match it type of scenario. But where does this leave the property companies?
Yes, and that's essentially where I wanted to sort of
properties
run to.
I'd been buying, and I don't buy individual property stocks because I've never gone down that road of fully understanding them enough, so I buy the ETFs. But if you look at the J253, which is the SAPI property index, I mean, it's just falling and falling and falling.
Even here, so looking at the biggest losers, right there, you've got Fortress, but they're there,
Yeah, and if you speak to Clean Glover, head of property at Standard, he will tell you cheapest in 15 years. And there's 2 metrics. One is price relative to NAV. Prices are at or about NAV, and yield above your government bond, which is about 8, and yield is about 9 on the property. So we haven't seen this since early 2000s. This is the cheapest. But there's two halves to each of those stats. So price to NAV, well, are the NAVs solid? We saw Sensite from Redefine yesterday in their UK operations, RDI, and they're saying, look, some of the buildings we have aren't actually worth what we think they are, and there's some issues there and stuff. So maybe NAVs are inflated. My sense is, even if by 15 or 20%, which is a lot, the prices are still offering good. The increases that they're able to push through to their customers mean that the yields are static at best. I think property is cheap at this point, but let's go forward 10 or 20 years where we're going
to be.
I mean, I'm in Dundee, the tiny little town in northern KZN, whose claim to fame was a couple of battles that happened in the 1800s. And they've got these fancy malls. Oddly enough, the Woolies was not a food Woolies. Typical Joburger. I look for Woolies, I find it, I drive to the Woolies,
and
I walk around. I say to the lady, where's the food? She says, Pick n Pay. I said, no, I want Woolies food.
But I think that makes sense in Dundee.
It makes sense. It didn't make sense for me personally, but yes, it makes sense. But so we have an issue with a lot of malls, and I don't know how this plays out. In America, there are abandoned malls, but I mean,
ghost malls.
Ghost malls. That's the phrase. I mean, is that where we're going to? We've seen a lot of Rosebank, the Galleria is gone, and now it's going to be a block of flats and stuff like that. So some of them can be knocked down and rebuilt. But my sense is that if we play this out over the next couple of decades, is we as a country are over-mauled. And I don't know what you do with excess malls. I mean, offices, you flip them into apartments, and this. Yes. I mean, there's
ways around it.
But a mall, I don't know. I mean, so as much as I've, thrashed out my entire tax-free into property ETFs and everything like that, they're cheap, but there's not an absence of risk there at the same time.
And the long term.
But that risk is longer term out, because retail will shift gradually. We've got to get our online shopping. I forget the exact numbers, but like we do 1% or something online. America's at double digit, sort of maybe mid-teens. We are a long way behind America. And truthfully, the high streets of New York and London and Santon are still there and happening and busy.
No, they are.
This is not a 2020 problem, but it is something that is lurking somewhere over the next many years, which gives the companies time to adapt. Some won't.
And I think perhaps while we're in that space of looking toward retail, I find it always interesting to sort of observe what kind of items people buy online and what kind of items people prefer to buy in shop, in the shops. So I want to go, and I've definitely found people take a preference to clothing, so things I'm going to wear. So excluding shoes, I generally want to be able to walk into the shop, fit them, and buy them. Whereas utility things, so things I'd need for the house, machines, laptop, people actually are quite okay buying online.
No,
so
and the clothing, and food.
And apartment things.
Yeah, and food is one of the things which none of our food retailers have really got it right. I tried Pick and Pay, Checkers, and Woolies. And they were all, to varying degrees, very poor experiences. The worst was the one who said, "Do you want packets?" So I said, "No, I'm trying to save the world." So they literally arrived and took everything out of a box and stuck it on the pavement outside my house. And I'm like, "You're kidding me. Can I at least borrow the box for like half a minute?" But clothing is, and we're starting to see it in the US, where it's starting to happen. So what you do is, you want to buy a dress, well, they'll send you 3 sizes. Because that's actually cheaper than sending you the one size, which you then try and then again. They just send you 3 sizes and say, send back as many as you want. And as you say, no fee for it. But it is to a degree the last frontier. We started with banking and air tickets and travel and that sort of thing, and computer peripherals and home stuff, and yes.
Yeah.
Clothing is going to be that last frontier. And clothing, walking through the zone now, clothing is the last frontier in the malls as well. It's what they are most of.
Still very powerful thing. All right, Simon, thank you very much for your time. As always, much appreciated. And we will chat next month, just before, maybe just after elections.
No, we'll get this back on track. We'll do it before the election.
Yay.